Most Kiwis treat their mortgage like they treat their barbecue. Shove everything on it, close the lid, hope for the best.
Oh, gee.
For 90% of Kiwis, the mortgage structure is bleeding them dry. The man with a name like a Bond villain is back, and Zhyang Cheng is an absolute genius in helping you pay off your mortgage faster.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button because the numbers don't lie. More investors are getting their New Zealand housing and real estate intel in 2025 from this show than any other YouTube channel. Z, what's the one mortgage myth you'd love to shove into a cannon and fire straight into Lake Taupo?
Yeah, Craig. So I guess one of the biggest myths that we hear all the time is that the banks don't want to give you money. The banks don't want to lend you money, and lending is getting a lot harder. But as a matter of fact, lending is getting a bit easier if you compare it to a couple of years ago. The banks actually want to give you money.
It's because they want to make money.
Of course.
They want to make money.
Of course, that's it. And look, there are obviously things that hold them back from, stopping the floodgates. So things like the DTI that's been introduced by the Reserve Bank. You've got the Responsible Lending Act. You've got things like the Triple CFA. These are things that control the banks, but they don't restrict the banks.
Is there one thing when you have someone come through that you always have to tell them that's not the case? Or are people pretty clued up these days?
I think generally people are clued up. There's a lot of information out there, so they do know what's going on, but,
Well, MortgageHQ preaches flexibility, capability, and certainty.
Yeah.
Sounds like a dating profile and not a financial strategy.
Yeah.
What does that mean to your average person with 2 kids and a Toyota with bald tires?
Yeah, I guess it's all about, having a plan, and having a plan in this game, and and paying off your mortgage and growing your wealth. It's not a sprint, it's a marathon, right? And it's also a game, and how you play the game differs at each part of each stage you're in. So in the beginning, sometimes you need to focus on a few things like paying off your mortgage and building that equity. As you progress, as you get deeper into this game, it's the way you play the game is different.
Well, people say they want certainty with interest rates, but then they lock in for 5 years at the worst possible time and act shocked when the market shifts.
Yeah.
Is this certainty?
Yeah, I mean, 5 years is a certainty, but the way that you got to think about it is certainty is not always good. If you have a rate that's locked in at, say, 7% for 5 years, yes, you have certainty, but do you want that certainty is the question.
How many people at the moment are locking at 5% with the OCR going down? I'd say very few, wouldn't it?
You mean 5 years?
Yeah, 5 years.
Yeah, I'd say most people are locking in, within the 2-year period at the moment. Some, yeah, I mean, with obviously having different tranches of lending and across different terms, but generally.
We're breaking down interest rate averaging. You talk about multiple loan chunks to reduce exposure.
Yeah.
But doesn't that also make refinancing and reshuffling more complex later? How do you balance that?
Yeah, look, obviously when you refinance, there generally should be a purpose behind why you're refinancing. So we don't want to just refinance our clients for the sake of refinancing. And not necessarily always, because yes, you might be locked in longer terms, but you can always break your loan. Yes, there are break fees, but some banks can offer you cash incentives to offset that break fee. And also when you're breaking your loan, a lot of the times the interest that you save by fixing into a lower rate outweighs the actual break cost. So obviously any advisor or we can do that for you. We can do the calculation for you.
Let's face it, a lot of Kiwis love being able to say, hey, I'm mortgage free, but they also like going to Bali.
Yeah.
How do you shift a mindset from owning everything to being strategic?
Yeah, I think it comes back to what we just discussed before about it depends on where you are in your what stage you're in. In the early stages, it's all about delayed gratification. Every extra income that you have, you should be putting more towards your mortgage. You should be building that equity up. Once you're in a more mature stage and you've got a bit of equity, you've got other sources of income, then of course you can go on more holidays. So I'd say the way you balance it is you make the sacrifice earlier on.
Interest rate averaging sounds smart. splitting the loans across different terms helps to hedge your bets.
That's right.
But isn't that like putting one leg in hot water and one in cold and saying you're having a warm bath?
I mean, that's right. But if you get it wrong, it could mean that you have both legs in the boiling water.
So how many people are doing that?
I guess that's the general advice that we offer. I think having your loans split is always going to be you can't really go too wrong with it, is what I say, because it's not a sprint. You're not trying to gamble on what the rate's going to be. You just want the certainty of the repayments. Not certainty, but you want to have your payments somewhat certain for across a longer period of time, rather than trying to gamble and get the rates right.
Let's talk revolving credit, the sacred cow of mortgage video hacks. Great if you've got discipline, but most people treat it like a bonus round on a poking machine.
Yeah.
How do you stop that?
Again, it's all about discipline. And if you don't have discipline, then sometimes the revolving credit is not the right product for you. Sometimes you might need to increase your repayments and force yourself to make those savings, as opposed to using the revolving credit. If you have the discipline, then the revolving credit is great.
Can you give me a percentage of how many clients come to you with discipline?
Oh, it's a very hard number to put on that, but I'd hope to say most of them.
But we hear that our spending habits are poor.
Yeah.
So you'd see it firsthand. You see the bank statements.
Yeah.
The media would suggest that we're not disciplined.
Yeah, again, it's the general population is they are spenders. They're not able to make those savings. But when a bank gives you a loan, they always give you a loan that you can afford, and not just afford. It's a loan that you're able to actually make savings on, because they will always test your interest rate on a much higher rate. So if you can afford that, then they'll give you a loan. So there's always a bit of a buffer. So I'd say we are a nation of spenders, and but at the end of the day, we still have the ability to save if we put our mind to it.
Look, I'm going to address the elephant in the room. I know you're a Kiwi, but you're Chinese blood. The
Yep.
Chinese are much better,
Yep.
discipline-wise, with money. What can someone like me learn about the Chinese culture when it comes to money and discipline?
I guess, look, I think the way that the Chinese think about money is a little bit different. Chinese didn't, over the last 40, 50 years, China wasn't a rich country.
No.
Right? We were very scarce in resources. So anytime we had our hands on any resources like money, it was a very important resource for us. So I guess that they brought that mindset across to when they immigrated out to other countries like New Zealand. They took the mindset with us. We took the mindset with us, I'd say, and we sort of we saved. I guess a story that I could share is just my own parents. Right, when they first came to New Zealand, 20 years ago now, 30 years ago now, they were working minimum wage, and they were able to save for a deposit and look after us as children and my grandparents. So they were able to save for a deposit and purchase a house. So we had to make the sacrifice, and yes, house prices were much cheaper back then, but it's...
Do you feel like you missed out? Like, it's one of those things that's so hard in everyone's life to balance it out. Now, not looking for sympathy from you when I say this, but my sister died of cancer, had lots of money in her bank account, but she wanted to save money. For me, that's a life half lived. So I'm trying to work out, there's a lot of people out there who will be thinking, what's the balance? Did you feel like you missed out? Because the Chinese, no doubt, are far more disciplined than people like me.
Yeah, I guess yes and no. The Chinese mindset, it's all about family. Sometimes it's family is more important than yourself. So my parents, they never had desires to go on holiday or go to, buy nice cars. For them, it's all about.
But was it a life half lived? That's what I'm saying to you.
It is. It could be. Of course, it is. It is a life half lived. But at the end of the day, I mean, you asked me about the the Chinese mentality, the Chinese culture, and that's what it is.
Ultimately, it comes down to happiness, though. Mum and dad are happy.
They're happy. Yeah.
All right, if someone saves $50,000, sure,
Yeah.
revolving credit makes sense.
Yeah.
But most people are trying not to cry when Countdown prints the receipt.
Yeah.
How do you tailor this for real incomes?
Yeah. What I would say is most people have the ability to save it, as mentioned before. They have the ability to do it. It comes down to discipline. And look, it's sometimes it might not be much. So what I would say is, it's not always about you trying to save every dollar. Sometimes it's about how you can think of different sources of income, different avenues of income, how to earn more money, ask your boss for a pay rise, do better at your role. So it's not always about saving.
The floating portion of revolving credit is usually 1% more than a fixed loan.
Yeah.
How do you help clients mentally justify that cost when their instinct is to chase the lowest rate?
Yeah, that's a good question. I would say inherently the revolving credit limit is a very small proportion of your entire loan. Typically, it might only be 5 to 10% of your entire loan. So yes, your entire loan is still going to be fixed on a fixed rate at the lowest rate. And the revolving credit, yes, you pay a higher rate, but you also have the flexibility as well. You've got the flexibility of putting more money towards it and take money out of it. So that flexibility comes at a cost. So what I like to say is even, let's say you've got a 50 grand revolving credit facility and you've got no money in there, right? It's a 1% higher interest rate than a fixed rate. So let's say on a fixed rate, you're paying 5%, revolving it's 6%, right? That's only $500 extra a year. So it's not necessarily, you're not going to lose your house. It's not going to cost you an arm and a leg, right? It's a little bit extra, but you're paying that a little bit extra for the flexibility. And if you do it right, you're going to save money.
A reminder again, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.